Vikash here from Galaxy of Homes. I'm just going for a meeting. I just thought I'll do a little video on tax planning. How can you save tax on your rental profit? So let's consider 3 or 4 different scenarios. Number one, where you're buying the property in personal name and you are on a higher tax bracket and your partner is at a lower tax bracket. In that scenario, you should always buy in your partner's name. And the reason is obvious: to save maximum tax. The second scenario could be where you are on a tax bracket either lower or higher, but your partner is currently not working, so doesn't pay any tax. In that scenario, ideally, you should buy in your partner's name, but you can't, because to get a buy-to-let mortgage, you need to earn around £20,000. So in that scenario, what you should do is buy in joint names. Okay, and then you file a legal document with the land registry, which is called deed of trust, whereby for tax purpose you're transferring 90 to 95% of share of the house to your partner, who is under no tax bracket. So this is a really clever way to save tax, and 99% of people or the landlords doesn't know about this. It can easily be done. So scenario 3, where you both are on a higher tax bracket. Now this is quite tricky, but there is a way you can save tax. You may consider to buy the property in a limited company name, in which case if you won't withdraw the rental income, then you are not paying any personal tax. All you're paying is corporate tax, which is around 20%. However, there are few caveats for this. Number one, you can't get a buy-to-let mortgage generally if the property value is below £50,000. Okay, that's quite key. Number two, interest rates are generally slightly higher when you're taking a mortgage in a limited company. So you must consider that. Thirdly, arrangement fees, product fees, all these are generally a bit higher for a limited company mortgage. So another top tip I wanted to give, especially if both the partners are in a high tax bracket and you want to buy jointly, is go for the deals where you have to do a good amount of refurb, let's say 10 to 12,000 pound refurb, because all of these refurb are generally tax deductible unless it's there a major extension. So changing a new kitchen or new bathroom, carpets, painting, these are all allowable or tax deductible expenditure. So let's take a scenario where you're doing a refurb for around £12,000, and let's say the rental income from these houses on an annual basis are £4,000 per annum. So in that case, you're not paying tax for 3 years, because you have 12,000 to deduct before you go into a positive profit. So that's another good way to save tax, to go for a high refurb projects, which in return also gives you better capital gain.